Monetary policy is the decisions made by the central bank and/or the government on the rate of interest, the money supply and exchange rate. It is a demand-side policy as it seeks to influence aggregate demand. The main instrument used in achieving government objectives is the rate of interests in many countries, which include UK, USA, the EU zone and other. How does the change in interest rate affect consumption and investment? The interest rate is the percentage of money people get in return for their saving in banks. If the rate of interest decreases, will mean that less people will be willing to save and the consumer expenditure will increase. There are people who are saving until they reach a certain amount of money, and a fall in interest rate will mean that they need to save more, but in developed countries this people a small percentage as borrowing seems more convenient. The interest rate also influences investment as lower interest rate will mean the cost of borrowing is lower. There are a lot of companies who used borrowing as a main method of investment. A rise in investment and also consumer borrowing will increase aggregate demand and put a pressure on price level, which will cause the Bank of England to increase the rate of interest in order to stabilize inflation. How does it influence the exchange rate? A rise in the interest rate will mean that people who search for short-term interest rate rises will buy the pound. A rise in demand for pound will increase the value of pound. If the rate of interest falls, there will be the opposite effect as people won't see it profitable to keep their money in UK financial institutions. This may not always be the case, as a decrease in interest rate may increase the economic stability of the country, because of higher investment and more people will want to buy pounds. Problems with change in the interest rate. The change in interest rate may not always work if it is too low, like it was from 2008 until now just 0.5%, which means that a decrease in it to 0.25% will have less effect on people. Also, in a period of recession, people won't react to a change in interest rate, because of low consumer confidence. Secondly, a change in the interest rate will have an effect after 2 years from the period it was changed. So the Bank of England is trying to predict what rate it should put now in order to meet the target after 2 years, which is 2% inflation. Another issue is its effect on other government objectives, as higher inflation may decrease inflation, but it will increase unemployment and decrease the level of economic activity in the country. Changes in the money supply. It is also called quantitative easing. It usually is done by increasing money supply, also called printing money, which will increase aid by making it easier for banks to lend money. It is done by the Bank of England buying government bonds owned by the banks. In this way it will increase the amount of cash the banks have and they can lend money more easily. The big problem is that it causes inflation as aid rises. Another issue can be that it doesn't always work, like in a recession for example, as the banks think it is too dangerous to lend and is better to keep the cash. Debt or increase spending in the future.